Two wars and a government shutdown looming, and Moody's putting the U.S. on negative credit watch, and the markets care not at all? Interesting. Welcome to Macro Money. This is Ilya Spivak, head of global macro here at tastylive. And one of the interesting things we're going to touch on today is indeed going to be whether any of this bad news that ostensibly is hitting the wires matters to anybody. Because looking at the way the markets performed last week and looking at the start of this one, the answer might very well be looking like, no, nobody cares, and we're just going to keep going. So let's consider what it is that we are looking at here first. We'll consider what last week's price action is telling us about investors thinking, and then look at the key macro waypoints that are going to shape price action in the coming 5 days here. We'll start with some stage setting. So here's the performance for the major markets week ending November 10th. So last week. We'll notice that there's not really a whole lot of movement here. The U.S. 2-year rate moved up by a relatively decent amount, but that kept it well within its recent boundaries. And perhaps most importantly, that did not spook stocks. NASDAQ up almost 3%. S&P as a kind of catch-all for Wall Street up 1.25%. So clearly, whatever yields were doing here, it did not spook the markets enough to think that the Fed is going to do anything different or that any kind of a major change was afoot. In fact, it seemed to suggest that the markets broadly didn't care. And to that end, the rise in yields maybe had more to do with the generally more risk-on tone in the market and felt more corrective than anything having to do with the Fed doing anything different. The U.S. dollar edged up a tad. We can see the euro here, the dollar's most liquid counterpart, down all of 0.4%. So a narrow gain for the dollar after it got washed in the previous week. Of course, the prior week was Fed week, and the Fed told us unambiguously that they were biased toward a wait and see as opposed to keep hiking kind of stance, and the markets read that as rate cuts beginning by mid-year. Probably the biggest standout last week was actually the erosion in risk premium tied to geopolitics. So the real big movers last week, gold down almost 2 3/4%, and crude oil down more than 4%. One puts that together, and it looks like the market has concluded that new combatants are not going to enter the fray in the Middle Eastern theater. The Ukrainian theater seems to be faded into the background at this point, but that Middle Eastern theater was certainly a source of attention. For a couple weeks there, folks would not hold significant risk into the weekend. Of course, on Friday, we got a very different signal, stocks roaring higher into the weekly close, seemingly saying, we're not really concerned about this anymore. And the price action in gold and in crude oil very much comporting with that idea. Crude oil in particular signaling that nobody's going to be mining the Strait of Hormuz. Nobody's going to be fighting over oil in a way that disrupts deliveries. So unlikely that Iran enters the fray here. Unlikely that Saudi enters the fray directly. So the market seemingly said, well, this is going to be a bilateral thing. This is going to be Israel and Hamas, and it's not going to spill out. And that was apparently, looking at the price action here, the only kind of meaningful signal to take away from last week's price action, which of course is very interesting because not only did the situation not get any better, but a few additional risks perked up. As we just mentioned, we're careening toward another possible government shutdown by Friday this week. And over the weekend, to add insult to injury, Moody's, a rating service, put the U.S. on negative credit watch. And markets didn't really seem to care. Now, it does make sense that they didn't care. After all, the U.S. Treasury bond is the quintessential risk-free asset that is hardwired into the global financial system, and there is no alternative. Almost all market structure, as we know it internationally, is built on the premise that the borrower that is least risky is the U.S. government. That is a quintessential foundational assumption for how financial markets in 2023 are structured. And not just in the US, but generally. And to the extent that that's a quintessential feature of the world we know, there is no market price, as it were, whereby the markets keep functioning but that assumption is violated. So any kind of a sense that the U.S. might default is about as much of a priceable event as an alien invasion. There's just not a market price to discount that. So in a practical sense, it makes sense why the markets are generally opting to look the other way, because this doesn't really seem to mean much in any kind of relative sense. So with that in mind, we now enter a week that is much more full of event risk. And we'll look at the U.S. portion of it first, which is going to be a little bit out of sequence because the first part of U.S. event risk is toward the start of the week. The last bit is toward the end. And then there's some notable Chinese economic data in the middle, which will be very, very important. We'll do the Chinese bit second and the U.S. bit first. And for the U.S., it starts, not surprisingly, with CPI. The Consumer Price Index is the benchmark measure of inflation. It is expected to come down from 3.7 to 3.3%. Much of that is likely to be because crude oil has fallen back. And so we can see in the yellow bars there the price of energy. It's been negative over the past 3 months or so. It's become less negative, and that's given a bit of a lift to the index. And of course, now it's come back down. So as we look at this next report, chances are we get a little bit more of a negative influence on energy again. And so the headline number comes in. The core number, which is the one that's much more relevant for Fed policy, because there's not much the Fed can do about the international price of food and energy with its policy framework. It's that core bit that the Fed cares about. That is expected to hold unchanged at 4.1%. And of course, from the Fed's perspective, what they care about more than anything in that core is the service sector, of course. We can see here that is by far the place where inflation remains most significantly lingering. And the key issue is still the labor market. So we can see here that overall CPI is down quite a bit off the peak. So 3.3% would be in line with expectations, and that would be down from 9 at the high. For the core, we'd be holding at 4.1. That'd be down from 6.6 at the high. So overall inflation is down a good amount, thanks to the Fed's efforts. But labor market inflation is much stickier. And that's because labor contracts don't adjust down. They typically require layoffs and a kind of round of wage resets where people are laid off and then are rehired at lower wages. So we can see that because the labor market has been stickier, the employment cost index, the ECI in the yellow there, is only down from 5.1 to 4.3. So clearly much less than overall CPI. This is what the Fed is trying to engineer. They are trying to get that number lowered. We can see why it's been so sticky. There's still a meaningful deficit of workers, now down to about 3 million workers. That's off the high of 6 million in the second half of 2021, early 2022. But nevertheless, a 3 million worker shortage is not insignificant. And so what we're looking at now then is a situation where, as ever, the Fed is attempting to hold rates high enough that supply and demand align. Now, because supply can't be manufactured when labor is the issue, or the good, the demand must be brought down. And so this is the Fed's whole calculus, is as long as that can continue to happen, as long as we continue to get lower numbers on hiring, as long as there seems to be a cooling of the labor market, then some progress is being made. And the message that we are getting from the Fed is that there's enough tightening left in the pipeline from efforts that they've already done. They've told us that it takes between 12 to 18 months for a single rate hike to absorb, which means that the meat of tightening is still working its way through the economy, that essentially they've done enough at this point that once that is absorbed in, we'll be where we need to be. The second piece of this, and this is coming toward the end of the week, is the retail sales report. And this is, of course, quintessential because the bringing down of demand and the slowing of the economy such that the labor market adjusts has to, by definition, target the main engine of growth, and that is household consumption. So looking at retail sales here, a critical indicator for whether what the Fed is doing is working. And the expectation is that we're going to come in from a 0.7% increase in September to a decline of 0.3% in receipts this time around, which of course would be a welcome sign if you're a Fed official or a stock investor, because it would suggest that indeed further tightening is probably not necessary and a sooner path toward easing can be had. Now, looking at both of these indicators, the story is basically the same. Consumer confidence has, in fact, been easing. In fact, over recent months, we can see that overall sentiment, this is from the University of Michigan's closely watched consumer confidence survey, that we have seen, indeed, a pullback in sentiment, a pullback in the current conditions index, and a pullback in expectations. So that's a welcome sign. Now, inflation expectations in this survey are still a bit heady at 4.4% over 1 year, and they've been jumping, but that might have more to do with headlines out of the Middle East and people's extrapolating of what might happen with oil as a consequence, rather than anything that ultimately materializes. We'll have to see. But whatever the logic is, the upshot is that consumer sentiment has been cooling, and that's a sign that suggests that, in fact, retail sales might well be set to roll over here. Speaking of the labor markets, the latest NFP numbers suggesting that, indeed, slow progress is continuing. The latest number, 150K. That's down, and indeed we can see the trend in monthly payrolls increases has been lower. So it does look like we're gradually going in a direction where the Fed wants us to go. And perhaps most welcome in this story if wage resets is what we're after, is the unemployment rate has gone up a little bit and hit 3.9%, which is the highest it has been since late 2021, early 2022. So looking at that part of it, it does seem like finally the Fed is rounding a bottom on the unemployment rate and can be looking to hold for now and not need to hike further. And that, of course, is exactly what the markets want to see. The upshot for them out of all of this data, and perhaps the reason why they're willing to cover their eyes and cover their ears and ignore the various negative headlines out there, is the quintessential story in markets over the past essentially 2 years at this point, maybe even a little bit more, has been that the cost of money is going up. And that's a bigger concern than deciding I want to invest in this or that. I want to buy this or that car, or I want to get this or this washing machine, or as a business, I want to expand or not expand. I want to hire or not hire. Before you get into all of those conversations, any kind of economic activity at all, at the household level, at the business level, at the investment level, you name it. The first question is, well, how much is it going to cost? And how much can I finance it for? So what is the actual cost of capital to do stuff? And from the Fed's perspective, the story has been, well, we have to raise that cost if we are to bring inflation down. And the market has been waiting with bated breath for the cycle to flip, from looking to where the Fed is going to make this more expensive to when the Fed is going to start to making it less expensive. And as long as the data coming in here does not suggest that there is a break in that shift toward capital becoming cheaper in the nearer term rather than more expensive, there is some reason for optimism. And the baseline looks essentially like this. So we can see here the probability for further tightening peaks out at 28% in January. You can see that in that number hikes cuts column. So there's a cumulative 28.3% chance that the Fed is going to raise rates again in this cycle. The likelihood of a cut starts to look very acute by June, where it seems to be 78%. The first cut fully priced in by July. You can see there by the time we get to July, again in the number hikes cuts column, one full cut minus one is there. So that's a 25 basis point cut. And a 34% chance for a further cut are already fully baked into markets. We get the second cut by November. We get the third by December. So the markets are at this point saying we're going to start to see cutting at mid-year essentially, and there's going to be 75 basis points or 0.75% of cutting to be done through the back half of next year. As long as this U.S. economic data does not alter that calculus, stocks seem likely to continue to find a way higher. The U.S. dollar seems likely to continue to backpedal against its major counterparts. The second part of this story, once we leave the U.S., comes to us in the middle of the week and comes from China. And here we're going to get a set of economic activity indicators. Industrial production is due. It is expected to hold unchanged at 4.5% year on year for the third month running now. No big news there. But retail sales looks like it's getting a little bit perky. 7% here would be the strongest since May, when we got a 12% increase. And of course, May, April, and March of this year were especially strong for Chinese retail activity. That's really where the meat of the post-reopening pop occurred. We know, of course, that China scrapped zero COVID restrictions in December of last year. And so as the massive population that is China was released from forced quarantine, people started to travel, they started to go to restaurants, they started to attend events, they started to move around. We understandably got a pop in domestic demand. It looks like that domestic demand may be trying to recover here after, of course, it fizzled in the wake of the reopening, running out of steam fairly quickly and essentially coming undone by the middle of the year. Looking at leading economic data here, things look predictably weak. We can see that early pop there in the services PMI, and so we can see where the spending went once those retail sales were picking up at the start of this year. And then come the first half, we were already on the way down. So it fizzled fairly quickly in the first quarter. We can see now services and overall growth, looking at official Chinese PMI numbers now, that's near standstill. 50 is standstill in the logic of PMI numbers, and as ever, above 50 is growth, below 50 is contraction. So the manufacturing part of the economy is still in contraction, and that's largely because China never really recovered its role as the value-add centered du jour for its major customers, the extent to which it dominated that space for the US and Eurozone in particular clearly has not been regained. And if we look at a private sector estimate of the same PMI data, we see essentially the same thing, standstill. But at the same time, if we look at the way Chinese economic data has performed relative to forecasts, so not in absolute terms, but in relative terms, since the middle of July, it has been improving. And more recently, it's actually climbed above zero, this surprise index, which tells us that at this point, Chinese economic data is actually performing a little bit better than expected. Now, as we just saw, that does not mean it's performing well. These numbers are not good. The economy is not doing anything good, per se. But the important thing is it's not doing things that are worse than anticipated. In fact, it is doing perhaps a little bit better than anticipated. Tellingly, if we were to look at a survey of Chinese GDP expectations for this year and next, they began to be aggressively slashed by around the middle of July because it started to look like the reopening was, in fact, going to disappoint. And so that reduction in expectations seems to have clashed with reality a bit here. So at first, the markets were clearly too optimistic, looking from April to July. And then it looks like they might have become a bit too pessimistic. And so now the data is performing a bit better than expected. As long as that is what we end up with on this industrial production and retail sales numbers, as long as the numbers are not worse, as long as they are tolerable, which is to say in line or close to in line or better, then there's really not a whole lot more bad news to price in. We've seen something like this in spades for Europe, where over the past several weeks, those markets have perked up despite the fact that they are almost certainly in recession, and in the case of the UK, in a stagflationary one. But the markets seemingly have concluded that, at least for now, the preponderance of bad news, the majority of it is already out. And so there's really not much more to price in. as long as that continues to be the case here too, then whatever these numbers end up being might very well be a trigger for a bit of catch-up. If we take a look here, we can see that Chinese assets have overwhelmingly underperformed, even relative to U.S. shares excluding tech. Now, of course, we can see tech was really the difference maker this year. U.S. stocks, including tech, up 15.5% this year. Excluding tech, they're actually down a bit, 2.4%. But Chinese stocks are down 11. So even compared with U.S. stocks absent tech, the story in China has been woefully negative. So if we get to a place here where the Fed is not expecting to do anything more because the CPI data, the retail sales data, isn't nudging them into a more hawkish direction, never mind more hikes, but just a longer hold at these levels. And the data out of China is at least tolerable. Doesn't necessarily have to be good, just not worse. Then the story of this week may very well be the start of a move to erase some of this underperformance in relative terms for Chinese shares, and to that end, Chinese sensitive assets more broadly. Now, if we're looking at ETFs, that could mean an outsized push higher in FXI, the large cap ETF, an outsized push higher in ASHR, the ETF that tracks China's sort of catch-all CSI 300 index. That's kind of their version of the S&P 500. And similarly, related assets like the Australian dollar and perhaps even copper might catch an outsized lift. So while U.S. stocks may very well continue to go higher, the amplitude for gains may be greater outside of the U.S., and China and China-related assets may very well outperform in this current environment. And that could well be the theme we walk away with as this week ultimately wraps. And that is Macro Money for today. Thanks very much for joining. We're here as ever Monday through Thursday, right after overtime, a show that I co-host with Chris Vecchio and Dylan Radigan, where we go over what happened on Wall Street on a given day, attempt to contextualize it, attempt to figure out where things are going next. I'm back on with Chris for Futures Power Hour on Fridays, on with Tom and Tony for First Call on Sundays, writing for the News and Insights section of tastylive.com, and sporadically opining on the platform formerly known as Twitter, at Ilya Spivak. Thanks very much for joining. Good luck trading out there. See you tomorrow.